You can see on this diagram a very ragged chart. In other words, if this is a patient's heartbeat or whatever, you can see that they're reaching crisis as we move towards the left-hand side. They're starting to go, those beats are starting to go off the scale. And the reason that that's happening is there are increasing tensions in financial markets. It's becoming more difficult for dealer banks to either provide high quality or get high quality collateral or provide the liquidity that is needed to undertake those loans. So it's giving us an early warning sign that liquidity is beginning to contract.
Financial markets are not just about price charts or headlines. They are built on the flow of money itself. And when that flow begins to dry up or move unevenly, the consequences ripple across every asset class. We are now entering one of the most precarious phases of the global liquidity cycle, a period that could set the stage for the next major crisis. According to Michael Howell, CEO of Cross-Border Capital and one of the world's leading authorities on global liquidity, the system is flashing early warning signs. Stress is emerging in the deepest parts of the financial plumbing: repo markets, collateral chains, and SOFR spreads. These are not front-page indicators, but they are the heartbeat of the system, and right now, that heartbeat is showing signs of distress. Howell argues that we are nearing the end of a long liquidity upswing that began in late 2022. Historically, liquidity cycles run on a 5 to 6 year rhythm, and while this bull market isn't finished yet, the signals are telling us we're approaching the top. Beyond 2026, the system could face an extremely challenging period, one dominated by tighter credit, destabilized collateral markets, and massive refinancing walls that threaten to test even the most resilient economies. In this video, we'll unpack Howell's latest analysis, break down how the liquidity cycle is shaping financial markets, and explore why this matters not only for stocks and bonds, but especially for hard assets like gold and Bitcoin. Stay tuned, and if you find value in deep dive insights like these, make sure to hit the like button, subscribe to the channel, and ring the notification bell so you don't miss what's coming next. Thanks, and enjoy the video.
I think the place to start is really with liquidity and the liquidity cycle. And there's a slide I've actually put up that you can hopefully see, which is looking at the cycle unfolding really since the mid-1960s. And this is looking at money flows that are moving through world financial markets over that time span. And it's very cyclical. You can see that. But after all, that's the experience we've had. We've had very cyclical markets over that time frame. Clearly, there's a trend, but it's the cycle that we're really interested in. And really since, 3 years ago, late 2022, in fact, almost exactly 3 years ago, this bull market started with a big upswing in liquidity. Now, as you can see from the graph, we're still in that upswing. The red dotted line is a sine wave that we put on top of that cycle around 2020. So it's had a long history to unfold, as you see there. In other words, it's pretty much unfolded as you have expected, with a fairly regular 5 to 6 year cycle. And it looks as if that cycle is pretty close to topping out. We're not there yet. We may have a little bit more to go, but we've got to be thinking much more about the end game rather than the beginning. And the downswing, through 2026 may be a challenging period. So we've got to think about this pretty carefully. This is the cycle of liquidity, let me stress. It's money flow through financial markets. It is not measuring the tempo of economies. And I would say, actually, in reality, since the COVID crisis, we've seen economies flatlining. And I don't think economies have made a huge amount of difference to financial markets over that period. They've been a kind of red herring in many ways, leading people down wrong avenues. And in fact, we've faced an absolutely plain vanilla investment cycle. Everything has gone pretty much according to normal script.
Can you walk us through the thinking around the end game? How do you need to think about that?
In fact, if you look at the next slide I've put up, what I've done is to try and put this in context. So the red line on the chart is looking at the current cycle. The 0 point that we plotted right in the middle of the graph is the low point in liquidity. And that has evolved counting months from that trough as you move to the right-hand side. The black dotted line is an average cycle. averaging the data since 1970. And you can see that, broadly speaking, we're following a fairly normal liquidity cycle. It's not falling. I mean, one's got to stress that, but it looks as if it's sort of laboring to get new highs. And that's certainly the concern that we've got. Now, your question, or the relevant question, is what actually causes the top? What causes the crisis? And I think there's a number of things that we can cite, but I mean, foremost is really what central banks are doing, because central banks have been so instrumental in launching this bull market. And what we want to really understand is what's going to end it. Now, if I sort of shift on maybe a few slides to what's happening in terms of liquidity, I'll come back to the other thing. This slide here is admittedly a schematic diagram, but it basically tells us how the global financial system works. And it shows you not only the upswings, but it also describes the downswings. And the point about the modern financial system is it's integrated, or liquidity is integrated really closely with debt. We live in a debt-dominated world, and I can't stress that enough. It's a really key point. The thing is that the paradox that is behind the whole system is that debt needs liquidity and liquidity needs debt. Debt needs liquidity for refinancing, and liquidity is often built on a collateral base, where that collateral base is high quality government debt, which is used as collateral. Now, if you get any dislocations between those two wings of the diagram, you can get financial crises. Now, the key thing to understand is, and this is a development that has evolved principally since the global financial crisis, 15 years ago or so, it's that something like 80% of all lending in the world economy now is collateral backed. In other words, it has as collateral either real estate value, thinking of the home mortgage case, or if you're looking at financial transactions, the collateral is mostly pristine government debt, such as US treasuries or German bunds. Now, the integrity of those bonds, of that collateral, is really key to understanding the liquidity process. And what we say on the left-hand side there is there are two indicators that everyone can monitor that are pretty good bellwethers of that particular process. One of them is the MOVE index, which is a measure of bond volatility. So if you've got a lot of volatility in the bond markets, then you're going to have a lot of volatility in financial markets generally. And ultimately, liquidity will contract, and that will be a bad environment. The other is, which may be a precursor to that, is to look at something which is a bit wonkish, but is called SOFR spreads. Now, SOFR interest rates are the interest rates that have replaced Eurodollar rates. They're the ones that are really the key interest rate in the whole, not just US system, but the whole world financial system. And they can be monitored daily. Now, you can see on this diagram a very ragged chart. In other words, if this is a patient's heartbeat or whatever, you can see that they're reaching crisis as we move towards the left-hand side. They're starting to go, those beats are starting to go off the scale. And the reason that that's happening is there are increasing tensions in financial markets. It's becoming more difficult for dealer banks to either provide high quality or get high quality collateral, or provide the liquidity that is needed to undertake those loans. And so what is at risk here is the things like the treasury market could become destabilized. Things like you've heard about the basis trade, which hedge funds are undertaking, could suddenly contract. All these things are really at risk with with high volatility in the repo markets. I mean, this in another way is really the heart of the system. And you can see it doesn't look particularly healthy right now. And that's one of the things that we're concerned about. So it's giving us an early warning sign that liquidity is beginning to contract.
As Howell explains, the liquidity cycle has played out almost like clockwork since the mid-1960s. Each upswing fuels asset markets, while each downswing delivers painful corrections and financial stress. The upswing that began in late 2022 has powered today's bull market, but Howell stresses that it is now laboring to make new highs. That's a critical signal. It means the fuel driving risk assets is still present, but running low. And when liquidity fades, financial markets, not economies, are what crack first. That leads directly to Howell's deeper concern, the structural integration between debt and liquidity. Since the global financial crisis, roughly 80% of lending has become collateral-backed, with government bonds serving as the cornerstone of that system. When bond volatility spikes, the value of collateral becomes unstable, forcing lenders to demand bigger haircuts. This tightens credit conditions, squeezes liquidity, and sets the stage for cascading crises. Which brings us to Howell's next major warning.
What I put up here is the MOVE index, a chart of that. Howell is a great guy, really worth paying attention to. And this is his baby, if you like, the MOVE index, which is a measure of volatility across the US term structure. And you can see that that has a normal zone that we've indicated, that gray band at the bottom. And essentially, if it starts to move up appreciably, it's measuring higher volatility in the bond market. And the reason that that's a worry is that if you're thinking about taking collateral to back a loan, the more volatile or more unstable your collateral, the bigger the haircut you're going to ask for from the borrower. And that means that they can't borrow so much, so credit conditions tighten. And what this is basically demonstrating is that the Treasury and the Federal Reserve together, in my view, have been trying to orchestrate a lower MOVE index. So they've been doing lots of things like running down the reverse repo program, things like Treasury buybacks. All these are attempts to try and rein in volatility because it's such a key variable in terms of leveraging this or enabling the system to leverage upwards. The problem is as we indicated, in the repo markets, you're starting to get a breakdown that may cause bond volatility to spike, and that will cascade. Now, why is this important? Let me go back a couple of slides to this one. Now, this is looking at really the overall problem that economies are likely to face or financial markets are likely to face. And this is looking at the debt liquidity ratio in the world economy, or to be 100% precise, the advanced economies worldwide. Now, what this is showing is a ratio. And what you can see from that chart is the ratio stabilizes. It has an average value that it seems to coalesce around, which is roughly speaking 2 times. So it's saying that the amount of debt in the system for normality or for stability has to be about twice the level of liquidity, or to put it another way, liquidity has to cover half the debt. And the reason for that is that debt needs to be refinanced. In other words, if you take out a loan, it's got to be repaid at some stage. Now, we know the spoiler alert is that debt's never repaid, it's only rolled over. So effectively, this is a refinancing measure. And so if you have to refinance debt, you need balance sheet capacity among your banks or credit providers to refinance the debt. If you don't get that balance sheet capacity, in other words, if there's not liquidity in the system, you'll get a financial crisis. And all the annotations that we show on the chart are previous financial crises. Coincidentally, they all seem to occur when you've got very high debt liquidity ratios. In other words, when you've got tensions in repo markets or in financing markets. The other side of that story is what happens when you get a very low ratio. When you get a very low ratio, there's excess liquidity. The vent for that excess liquidity is asset prices. And every one of those spikes downwards seems to have coincided with a major bubble in asset markets somewhere. And the big one we've just come through is what I've called the everything's bubble, or what is generically called the everything bubble, which has basically launched everything to higher highs. Now, we're enjoying that for sure. But if you look into the future, that is likely to reverse. And it's reversing for 2 reasons. One of them is that the pool of liquidity is being challenged, partly by the Federal Reserve and what the Federal Reserve is doing, which I come on to, and partly by the fact that, as this next chart says, there's an increase in the annual debt roll. Now, what do I mean by that? Every year, new debt has to be refinanced. And you're looking at a figure of somewhere between $35 and $40 trillion worldwide to be refinanced in markets every year. Now, as I've said before, financial markets today are dominated by these refinancing flows. It's all about debt refinancing. Forget the idea, the textbook idea, that somehow financial markets provide new financing for capital investment. They don't. It's all about debt refinancing. So this is what we got to focus on. Is there enough liquidity to refinance debt? And what you can see there is the orange bars, which are actual data points, and the red bars, which are extrapolations in the future. And you'll see there's a big bite out of that chart in 21, 22, 23. And that period was one where we had ultra low interest rates following the COVID emergency. Central banks put rates down at near zero, in some cases negative rates. And that caused a lot of borrowers to refinance their debt. They termed out debt, to use the expression, and they termed debt out to the later years of this decade. In other words, it's coming back into the system to be refinanced again from 26, 27, 28, 29. And this is the annual change in the debt roll, not the actual amount. This is saying how much each year increases over the previous year. Now, all I'm trying to say here is that we've got to remember that there's an echo effect in the system from what happened during COVID times. And that echo effect is the debt refinancing cycle. And that period during COVID was an anomaly. Everyone will remember that it was an anomaly. But in history, it was the most astonishing anomaly when you start to think about interest rates. When I was at Salomon Brothers, US Investment Bank, we grew up on a book which was called The History of Interest Rates by the former head of research at Salomon Brothers. That book basically said, it was by Sidney Homer, by the way, that book basically said that in 4,000 years of history, there has been not one example of zero interest rates until we get to 21, 22. And the period, in fact, more generally since the financial crisis, has been littered with very low interest rates. And what does that do? It causes huge distortions in markets. It encourages this whole mentality of taking on debt. And that's the problem we've got. Now that debt is coming up for renewal or refinancing. And that's a problem. So that's issue number one. Issue number two, which is to come back to this point about what the Fed is up to, is here is the growth of Fed liquidity. And what you can see is both the history and an extrapolation as to what's going to happen over the next 6 months, given what the Federal Reserve is telling us and what room they got for maneuver. And what you can see is you're likely to get a significant slowdown in liquidity growth. The last time that happened in size was early 2022, and financial markets were pretty bad during that period. It really took that acceleration in liquidity from the back end of 22, which caused this bull market. Now, what we're saying is you've got to be alert to that slowdown because it's happening.
The MOVE index, often called the VIX of bonds, is one of Howell's critical indicators. Rising volatility in U.S. Treasuries doesn't just signal market nervousness, it directly erodes the foundation of collateral-backed lending. To prevent this, the U.S. Treasury and Federal Reserve have been working behind the scenes, running down the reverse repo program and even initiating Treasury buybacks to suppress volatility. But these are stopgap measures. If repo markets continue to fracture, volatility will return with force, and when it does, the liquidity cycle turns down sharply, and the timing couldn't be worse. Howell points to the looming refinancing wall between 2026 and 2029. During COVID, governments and corporations locked in historically low interest rates, pushing maturities further out. That debt now comes back to the market for refinancing at vastly higher rates. We are talking about $35 to $40 trillion in refinancing annually. This is not about financing new growth, it's about rolling over old debt. And in a system already strained, that wall collides with a Federal Reserve actively slowing its liquidity injections, a setup eerily similar to early 2022 when markets cracked before stabilizing again. For investors, the implications are enormous. On the one hand, tightening liquidity and mounting debt pressures mean turbulence for traditional markets. On the other hand, these same pressures make alternative assets like gold and Bitcoin more attractive. When confidence in collateral erodes, when sovereign debt becomes volatile rather than stable, capital seeks out assets that cannot be debased or defaulted on. Crypto, especially Bitcoin, stands to benefit massively from this long-term shift, particularly as the liquidity cycle rolls over and trust in traditional monetary anchors begins to fracture. So, what does this all mean for you? It means that while the current bull cycle still has some fuel left, investors should be thinking about positioning for the endgame. Hedging risk, rotating into hard assets, and watching liquidity indicators like SOFR spreads and the MOVE index may prove critical. And as always, this is not just about surviving the next downturn. It's about being positioned for the next breakout when liquidity inevitably floods back in. And drop a comment with your thoughts on how you're positioning for the coming cycle. If you found this analysis valuable, make sure to hit the like button, subscribe to the channel. Thanks for watching, and let's keep tracking the signals that really matter.